Investors are gearing up for a big OPEC meeting on Wednesday. This could be the first gathering in about 2 years where the oil cartel doesn't simply carry on with its previous output plan. In other words, we might get some oil market fireworks. Joining us now, Jeff Currie, Goldman Sachs Global Head of Commodity Research. What are you expecting, Jeff?
Well, in terms of looking at, the overall fundamental picture, at this point right now, we'd expect that they would likely roll over. But I think, the key point here is that what we see in terms of the fundamentals of the demand, there is a slowdown occurring, but it's not a contraction. And I think that that's what's being confused in the narratives, is that there's a view that there's a potential big contraction recession going on that's broad-based across commodities given the pullback in prices. But the reality is that the underlying picture is slower demand growth after a very torrid pace earlier this year and not an outright contraction. So it's not like the fundamental picture is distorted extremely one way or another, but the financial markets are pricing in something very different. This is one thing I said last week and the previous week, is the physical markets are telling a very different story than the financial markets.
We would sometimes view the interest rate sector as a commodity. What the heck is happening there with the 10-year, Jeff? And does that inform your decisions and analysis about everything else?
Absolutely. It's very much like a commodity in the sense that the price has an economic purpose of either, creating or slowing demand growth, or creating supply or slowing supply growth. And so when we look at whether if it's the interest rates, the break-even inflation, the commodity prices, they basically priced in an environment in which energy crisis over, food crisis over, inflation under control. The five-year sitting at 2.3% break even. And I think the commodity markets are doing identically what the bond markets are doing. And that can really be seen by looking at the gap between the cash price for oil and where the forwards are trading. September Brent went off the board at $110 a barrel today, or on Friday. The next month out is at 102.50 this morning. You go further out, it's at 100, and it just keeps going down, where at 12 months out, you're at $90 a barrel. That does not mean the market is thinking the prices are going to go down over the next 12 months. What that means is that consumers are willing to pay a huge premium for physical delivery relative to what investors are willing to pay on the curve. So it's an opposite meaning.